Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Ryan Issakainen, Senior Vice President and ETF Strategist with First Trust, James St. Aubin, Chief Investment Officer and Portfolio Manager of Ocean Park Asset Management, and Dave Harden, Founder and CEO of Summit Global Investments. We're here to discuss what's changed in today's bond market that makes active management more important to help investors target income more intentionally. It is great to have all of you with us. Welcome back to Trade Talks. In some cases here, Ryan, a lot has changed in the bond market and the market overall since we last met. Why is active management, because of that, more important than it's ever been?
Well, I think because there's so much that's changing. Both, you want to be opportunistic, you want to look for opportunities as you have assets sell off, as you see spreads widen in bonds. And at the same time, you want to be able to manage risk. You know, if you're looking at passive funds and you're especially in a fixed income portfolio, oftentimes you're allocating to the companies or the issuers that have the most debt. There's not much risk management involved with that. And we think that active management is a good way to kind of get the best of both worlds. You're managing risk on the one hand, and you can be opportunistic on the other hand.
Yeah, and James, it's certainly not a set it and forget it bond world anymore.
It's not. There's a lot of moving pieces, and I would start with the premise that even historically, beyond what's changed lately, active fixed income has had a better success rate of beating benchmarks than passive. So your default, even before the current situation, should be active in fixed income because of the opportunities, whether it's to position on credit, duration, sectors, individual securities. Lots of levers to pull in the fixed income market. And there are plenty of non-profit maximizing players involved in the bond market, which gives you an added opportunity to add value over a benchmark. And that was a very good point, that the benchmark is made up of the largest issuers, have the largest weight. And I don't know if it's I certainly don't think it's a good idea to determine who you're going to lend to by how much debt they have. Yeah. And that's essentially what an index does.
And we're starting to hear more about the bond market and how it's being benched to the economy, and how we are anticipating and perceiving what the overall macro environment looks like. Stocks and volatility markets operate in a very different way than the bond market. And it seems to be that more concern and more light has been put on the bond market.
For sure, especially if you saw this recent downturn. Typically, you would see yields fall, right, as stocks fall together, so the prices of bonds appreciate. And yet, right when Liberation Day happened, right, you saw this reverse. You saw them come down a little bit like normal, and then they spiked, and now it's up, the 10 years at 4.3 or what have you. And I think that made people question, but I think the long-term play is still there, the diversification away from stocks when they're volatile. This market, people look to bonds for safety, they look to bonds for income, they look to bonds for diversification, and the reality is that's still all true. That still plays. And you did see that reaction where the stock market will pause, absolutely, and play second fiddle to the bond market when that yield is not doing as is expected. Yeah. And so you saw that for sure. And you saw President Trump change direction and give a pause to tariffs. And a lot of that came because, in a lot of views, because the bond market reacted.
Right. Yeah, well, everyone's trying to figure out, Ryan, is this inflationary? Is it disinflationary? Is it short term? Is it long term? And really looking to the bond market for clues. It seems to be, when you look at the broader indexes from the equity perspective, they tend to move in a very different way. You don't expect that kind of movement from the bond market.
Well, and there's so much uncertainty, and I think everyone's trying to guess what's going to happen, and they have the ability to have instant information, and they're trying to get ahead of all the other market participants, and that creates a lot of volatility. And yeah, you're right. We saw levels of volatility in the bond market that was the highest since 2023 in the first part of this month and first part of April. At the same time, we saw massive volatility in equities. And I think that as the uncertainty remains, we're going to see that sort of volatility. And the good news is, for investors that have a longer time horizon, they can take advantage of some of those dislocations and some of the sellers that want to get out at any cost. The long-term investors, those active managers, can have their buy list and they can look and see where there's opportunities and they can take advantage of that for their clients.
Yeah, and what's so interesting, James, going into the year, it was 60-40 model portfolio. It doesn't make sense anymore. Well, I mean, that narrative has changed when you want to make sure that you have a balanced exposure at this point.
Yeah, well, we know from our experience in 2022 that bonds don't always add ballast to equities. And typically that happens when inflation concerns are at the forefront. Inflation concerns are absolutely at the forefront when you talk about tariffs. Now, there's some discussion about what time horizon. You asked about inflation earlier. What time horizon is it inflationary? The bond market is telling us right now that over the short term, the 2-year break-evens have doubled from 150 to over 3% since August. Okay, so that's clearly a verdict that the market is given, that inflation short term, and that makes sense. It's a one-time price increase, not necessarily a perpetuating one, because if you look at the 5 and 10-year break-evens, those have kind of appreciated a little bit, and they've actually come down recently, suggesting that the market believes it could be actually disinflationary over the long term. So there's a lot of moving pieces here. When you start to peel back the onion on rates, you're looking at real rates and inflation break-evens and trying to figure out what's moving. And typically, when you have that 2022 experience, you knew that inflation was the story. It wasn't positive for stocks, and it wasn't positive for bonds.
Yeah, and then you have other considerations as well, Dave, when you think about pivoting in a more tactical sense, or you're considering interest rates, credit risk, and duration. All of those are factored, and you can't just pick a passive index or try to replicate it on your own in an environment such as this.
Very difficult, and I think that's where this active play, an opportunistic play, comes into play. And so I really think that right now it's a landmine economy, and you don't really know what's going to hit you at the next step. So when you're looking at fixed income and you're looking at that opportunity that you have, not only can you extend and get past some of these landmines and deal with them from the equity markets and from the kind of the political landscape in and of itself, but it also adds stability to your portfolio. Definitely 2022 was kind of the worst case scenario for bonds with inflation. That's out there. But if you look at the numbers on the equity side, most people are looking for about 3 cuts from the Fed this year. Most people, if you're looking out a little bit on the curve, they're expecting a little bit more, I think, a lowering of the inflation. And the consumer, that we learned this morning, is still pretty active.
Right.
So,
well, it makes you wonder, is it being pulled forward
Yeah.
because of the anticipation that tariffs are going to make things more expensive?
You definitely saw that in autos, for example. You saw a 5% increase there. A lot of that was probably pre-purchasing in advance for maybe some tariffs coming out.
Yeah, it reminds me, Ryan, during COVID, when people were making mass purchases of household items for that reason, expecting that demand is going to pull up the prices. But when you think about different verticals within fixed income, are there areas that are more attractive than others?
Yeah, I think there's a variety of more attractive opportunities today than there were at the beginning of April even. As we have seen some sell-offs, one of the areas that we're focused on is the muni bond market. We've got a few different actively managed ETFs. One is FMB, which is the First Trust Managed Municipal Bond ETF, and then FMHI, which is a higher income version of that. But when we look at the spreads within municipal bonds, they widened out just as you saw rates moving against you if you're an investor, and you saw prices come down, and that results in some yields that are very attractive. And it's also important to recognize that some of the reasoning why we saw a sell-off wasn't necessarily because of fundamentals, but more because of investors, the seasonality of tax day coming, maybe they want to sell. There's concerns about uncertainty about the tax-free status of muni bonds, which we think are unjustified. But there's all sorts of reasons why investors now have a better opportunity, especially if you're long-term investors, to look at those municipal bonds, especially if you're focused on actively selecting the issuers.
Yeah, and James, in what area would you find more opportunity within the fixed income space?
Well, look at this way. We talked about the entry point looking a lot better, right? Yields are higher, whether that's from spread or rates. So broadly speaking, fixed income looks better than it did a few weeks ago. As far as individual investors, I think you have to look at, pick your poison to some degree. What do you want to make a bet on? Is it rates or is it credit, or both? And I think it's very hard. Our strategy looks at trend following, and the trends in the bond market are negative. So we've been sort of on the sidelines because of that. And until we see the trends accelerate or continue to rise, I think we're going to be on the sidelines, mostly in cash, until that happens. I don't think there's so much unknown about this tariff situation that I don't think it's easy to call about what's going to work in the next 3 to 6 months, because we just don't know how this will play out. Anybody that says they can is probably fooling you, because if you think about like all the data you talked about, yes, retail sales look good in March. This is April. Things have changed. And we're still trying to figure out exactly how things have changed in terms of consumer psychology, business psychology, market psychology. Those things, until that gets sort of settled out, I don't think there's a clear opportunity right now.
Yeah, and David, what's so interesting is the operating environment flipped on its head virtually in an instant, right? So fundamentals of some of these, whether you're looking at the equity or bond market, were quite strong, and they were operating quite well. But it's trying to figure out what that's going to look like moving forward. Are there areas that you think there's opportunity in, or where you would when it's time to put cash to work?
I think there is. As that old saying goes, when one door door closes, a window opens, or what have you. That's definitely true. So I think the muni market is a great market. For example, I think you're seeing some really very good priced munis out there, and we do it on an individual basis. But whether you use ETFs, I think that's perfect. And then we also like cash. Our ETF in cash is USDX. It uses a money market kind of as its base, but then uses some options overlay, so it typically picks up a little bit more yield than a typical cash strategy. Those are good places to kind of wait it out if you're looking for perfect positions to buy. But some people just can't leave the equity market, for example. Right. And so I think something, if you're in equities, look at and let's say you're in the Qs, and that's where you need to play. That's when maybe you need to step out into like the QXQ is one of our strategies that has an income on top of the Qs, and there's other strategies out there. Those are very good alternatives right now in this space if you can't go to cash, right? And so and I'm not advocating to go to cash either. You should, it's kind of like a hurricane. If you're going to go out and put up, sheetrock, or not the sheetrock, that won't last, but plywood in the middle of the hurricane, you're taking a lot of risk. You got to prepare beforehand, and that's really important to manage risk before these storms come. And that's what these strategies are for. I look at these type of income strategies as not time sensitive. We got to get in a certain time. These should be part of the portfolio before you have these type of circumstances.
It's interesting, Ryan. It feels as if the Band-Aid was just ripped off, right? What if we had to wait a year or two, try to guess what tariff policy might have been like, right? Like we did with Trump 1.0. At least we came in, here's the issues on the table, and we know at some point that there will be a resolution. Imagine having to anticipate that a year in, 2 years in. So, I mean, that could be a silver lining.
Yeah, you're right. We can look back at 2018 and we can, history doesn't repeat, but it rhymes, and we can see some of the policies that were discussed and what the ultimate outcomes were, how assets responded to some of those policies in the ongoing year in 2018 in Trump 1.0. But, I think volatility can sometimes be your friend. We're talking about equity-like strategies that have maybe a derivative income component. When volatility comes, what also goes up is options premiums. And if you're writing call options, for example, against a basket of stocks, then you can actually get richer premiums, and you don't necessarily have to overwrite as much of the portfolio.
Yeah.
And we've got a couple actively managed strategies that focus on just that as well. FTQI and FTHI are two of the ETF tickers, where you can take advantage of volatility by writing calls and actually getting richer premiums.
Yeah, I also think we need to bring in the ETF wrapper in this conversation as well, James, and the advantages that they offer in terms of liquidity and tax treatment, too.
Absolutely. I mean, they give you a great opportunity to access all parts of the bond market. There's an ETF for just about every facet of the bond market you could think of if you wanted to take a modular approach and put together your own portfolio of different sectors and things like that, or you want an all-in-one solution. So the ETF wrapper gives you great tax efficiency. That happens in equities and fixed income, so that's a huge advantage that ETFs have over mutual funds. There's great opportunity in active fixed income. You've seen a absolute explosion in options in the active ETF space.
Yeah.
So before 2019, it was mostly a passive universe. And today, that option is open to active managers of all stripes. And that, I think, gives investors a lot of opportunity to make a portfolio that looks like what they want it to look like.
Yeah, which is so interesting. This isn't specific to fixed income. I don't remember the exact day. It was Monday, April 7th, but 48% of the volume were ETFs, the second highest since November 2008. right? And think about it, at that time, how innovative ETFs have been since then, probably trading bank ETFs, right? Financials for the most part in 2008, but 43% of the volume, and volume surges, in volatile markets such as this. I thought that was reflective of how investors are approaching ETFs in their portfolios.
Yeah. So if you look at the volume, just playing on that for a minute, it's really interesting. Biggest intraday moves ever in the S&P 500, the top 5 happened in the last 10 trading sessions, right? So there's a ton of volatility, and is that coming from ETFs? The ETFs are also increasing in their volatility in these same times, and the wrappers are great, whether you use a blue tractor type of wrapper or other type of wrappers. It allows active managers to provide that value to the end investor by also protecting their shareholders. Because passive, everybody's going to see it at the same time, where active wrappers can confiscate that a little bit and shield that to protect the ETF shareholders. Yeah. So now you kind of get the best of both worlds. You get the wrapper, you get the active management, and the ETFs can provide that.
Yeah, I thought it was just a testament to the industry.
But in those environments, you've also got to be careful and know what you're doing when you're trading, because spreads can widen, right? Premium discounts can change. So I think it's very important for advisors that they think about trading ETFs. Yes, they're liquid intraday, unlike mutual funds, but you could be paying for that liquidity in maybe non-completely transparent ways. So it's really important, I think, that advisors focus on how things are trading relative to NAV, if that's available, and then how wide the spreads are, because transaction costs can be material in highly volatile periods like we've seen over the last.
They certainly can, and Ryan, I think advisors also need to be aware of the underlying of what they're trading as well, because the profiles can be very different than traditional stock ETFs.
Yeah, absolutely. And to your point, when you look at some of those premiums and discounts, sometimes that comes because you're seeing massive amounts of creations or redemptions. And when that happens, it's actually a benefit to the existing shareholders in the fund, because they're not the ones that are necessarily paying for that. Mm-hmm. And that's actually one of the benefits, I think, of the ETF wrapper, because you can actually be a long-term shareholder and you're not having to pay for the transaction costs of someone coming in or coming out of the fund. And that's, especially when it comes to fixed income markets, that's a huge benefit of the ETF versus just a traditional mutual fund wrapper.
I mean, it'd be nearly impossible for an investor to replicate those types of funds anyway, in terms of efficiency, being able to trade, the cost. It makes a case for active management. You wouldn't be able to replicate it otherwise.
Yeah, absolutely. Well, the reality is, most fixed income funds, even if they say they're passive, they're optimizing a basket of bonds. In the fixed income market, they don't replicate like they do in the equity markets. So you have to make some active decisions when you're replicating and optimizing something. And so you can see some tracking error, especially with asset classes like high yield. Over time you see huge tracking error between a benchmark and an actual ETF.
Right. All right, guys. Appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.